Okay, we're now going to take a look at exercise 15-4. It's on pages 896 and 897 in your text. And here, you guys, we're dealing with the exact same problem, except instead of making the entries from the vantage point of the lessee, in this case, manufacturer Southern, we're making the entries from the vantage point of Edison Leasing, who's the lessor in this situation. It says, let's read through it. They say, Edison Leasing leased high-tech electronic equipment to manufacturer Southern on January 1, 2016. Edison purchased the equipment from International Machines at a cost of $112,080. The next group of information, the related information, is exactly the same as you had in exercise 15.3. Here they want a lease amortization schedule again and appropriate journal entries for Edison Leasing from the inception of the lease through January 1, 2017. Edison's fiscal year ends December 31. Now they're treating this here as a direct financing lease, meaning the seller, Edison Leasing, is essentially just financing the purchase of this equipment for manufacturer Southern. Now remember, we treat it, even though it's drawn up as a lease and called a lease by the two parties, from the financial accounting perspective, we're going to treat it as a purchase because that's essentially what it is. Remember, our criteria, the lease term has to be non-cancelable, and then one of these has to be met. Well, the non-cancelable lease term here is 2 years, and the useful life of the asset is 2 years. So it meets the criteria. So it's definitely a capital lease, meaning the lessor, in an operating lease, the lessor would still have the property as an asset on their books. Not so here. The lessee, rather than the lessor, is carrying the asset on their books. You guys, they asked for the amortization schedule, but I figured, why reinvent the wheel? I mean, we have the amortization schedule, right? We worked it on exercise 15.3. The only real change I made is instead of interest expense for Edison Leasing, this will be interest revenue. So if we go back over here, we can fill this in as well. Present value of the minimum lease payments was $112,080. The total of the lease payments is $15,000, 8 times. And then interest revenue would be the difference in the two, the $120,000 minus the $112,080, which is $7,920, which are these numbers you see across the bottom here. I didn't see the point in calculating out the exact same lease amortization schedule. We're just looking at it this time from the viewpoint of the lessor if it was a direct financing lease. We're going to look at a sales type lease using the same information in the next exercise. So let's go through and make the journal entries here for Edison Leasing. We'll start with 2016 and January 1. Alright, so we're going to start out by debiting lease receivable, which is an asset, of course, for Edison Leasing. For the present value of the minimum lease payments, $112,080. And we're going to credit inventory, they say, of equipment for the same amount, $112,080. What they paid for it. Remember, Edison Leasing paid $112,080 for it. So you might be asking yourself, how are they making any money? Well, you guys, on these direct financing leases, Edison Leasing is making their money in interest revenue. There's no markup. So they're actually they're putting the lease receivable on the books at the same amount they paid for the equipment that they're leasing out here. But they're going to make some revenue in the form of interest, right? Okay, so also on January 1st, they received cash of $15,000. This is from our top row here, right? On January 1st, they received cash of $15,000, so we're going to debit cash $15,000. And we're going to credit, you probably guessed already, lease receivable for $15,000. There was no interest involved because no time had passed off, right? So they didn't earn any interest revenue on that first payment. So now we'll go to the next transaction. It took place on April 1st. We'll debit cash. What we're really doing is making the entry now for this row. So how much cash did Edison Leasing receive? Well, they received the full payment, $15,000. Okay, and then we're going to credit lease receivable. It doesn't matter the order. I'm going to go interest revenue first. We're going to credit interest revenue for the amount of interest that they earned between January 1 and April 1. Well, how much is that going to be? Their interest revenue is $1,942. So that's our credit to interest revenue to increase its balance. And then they're going to credit lease receivable for the reduction in the principal balance, which was $13,058. Okay, now those two should total back to the $15,000. We know that they do, but let's check it to make sure. And that's the case. Okay, so that takes care of our April 1st, 2016 entry. So then we'll go to July 1. And we'll come down a row. Alright, first we're going to debit cash for the amount of the lease payment that would be received by Edison Leasing. We're going to credit the same two accounts. Alright, interest revenue earned would be the $1,680. And then the decrease to lease receivable will be the amount of the decrease in the balance, $13,320. Okay, that takes care of the July 1st entry. Okay, now we'll take care of the October 1st, 2016 entry. Same accounts affected. Well, we know the lease payment is $15,000. That's how much Edison is going to receive. How much was the interest revenue earned on that October 1st payment, 2016? $1,414. Okay, then the decrease in lease receivable will be the amount of the decrease in the balance here, $13,586. So let's make sure those come back to the 15,000, and they should. There you go. Okay, now Edison's year end is also December 31st, so we need to make our adjusting entry here. Edison will have earned some interest on this lease between the October 1st payment and the end of December. So we're going to debit interest, but they haven't been paid yet, right? So it's going to create an asset, interest receivable. For how much? Well, how much interest is going to be paid to them on January 1, 2017? $1,142. So that's how much they've earned by the end of 2016 between October 1st and December 31st. So $1,142 to debit to interest receivable. And they earned it in 2016, so we want it included in the interest revenue account in 2016. That's why we're making this adjusting entry. It gets all of our assets recorded on the books as far as interest goes associated with this lease, and it records the revenue in the proper period. Okay, now remember we made a depreciation entry on the lessee's books. That will not be made on the lessor's books here because we're dealing with a capital lease, and the asset is actually showing up on the books at this point of the lessee, not the lessor. So we get to 2017. And we do January 1. Okay, what's going to happen here? Well, we're going to debit cash again for the 15,000. We're actually just handling this row from our amortization schedule. It's a little bit different though because we set up interest receivable for the 1142 last year. So we debited cash for the 15,000, the amount of the payment. So we're going to credit interest receivable for the 1142, the amount it placed in interest receivable at the end of the prior year. We've now been paid, so that's no longer receivable. And then we're going to credit lease receivable for the difference in these two. Let's check it two ways. It should be the amount of the payment minus the interest. That's $13,858. That should also be the decrease in the balance for January 1, 2017. If we look at our schedule, $13,858. $13,858. So that takes care, you guys, of exercise 15-4. I didn't really see the need in completing the amortization schedule again, so I included it on your exercise 15-4 template. I think after working that one with me, you really shouldn't have any problems with the next homework exercise in Connect Plus. If you have any questions, please be in touch. Thank you.